Right, thank you for coming out tonight. It's good to see some familiar faces and some less than familiar faces and some old faces I haven't seen for a couple of years who normally give me abuse at my talks, so I'm looking forward to some interesting dialogue. I guess the key thing is security tokens. Obviously there's a lot of potential hype about it, and I guess what I want to do today is more look at the why of security tokens, because a lot of the actual technology that we've got is actually already proven, and well, I'll take you through exactly how this is going to work. Just a quick thing that I've launched a new podcast series, been interviewing a load of people. Interviewed Penny, who's a specialist. Where's Penny? Is she gone? Oh, who's a specialist in AI and blockchain, and a whole variety of interesting people, including institutional investors and that type of thing. So it gives an idea of a whole lens across the market. And I guess I've got to put this up here just as a disclaimer. The lawyers can look at the words and criticize me, that's fine. But there's nothing in here is legal or investment advice, just to cover that off, all right? I guess the first thing is, now this is a sort of a crypto community. So how many of you got Bitcoin right now? Okay, all right, that's good. All right, because obviously we know how that went. Now, how many of you actually own crypto besides Bitcoin then? Okay, now keep your hands up for this question. How many of you use the tokens for which you actually intended to buy the tokens? Keep your hands up. Okay, we've got a couple. Now, if you've got Ethereum and you've used that for ICOs, put your hand down. Okay, so we've got a couple. All right, and that's a fairly reflective sense of what's actually going on in terms of people are buying these historically for speculative purposes. Let's be honest. That's the pragmatism. And when we look at the ICO space, I mean the crazy volume of funds that actually came through at the sort of staggering level just at the end of July for the latest stats, just over 20 billion, which is kind of insane, really, when we look at it. But it's good that the money's actually sort of come through. But what we've actually had is the regulators being behind the eight ball. And it's very much that the regulators really wanted to understand the technology, because they have to understand it before they can actually work out what to regulate and then how to regulate. And this has been a major issue, obviously, as we've seen in the whole marketplace. And there has been, in many ways, this sort of an imperfect regulatory storm, in terms of there were lots of scams and thefts that we all sort of heard about. There's talk of finance raising. Are these securities? Are these not? We've got anonymity of cryptocurrencies and the issues of AML, anti-money laundering, know your customer, KYC, and counterterrorism funding, CTF. But of course, one other big issue is tax, and that's an area that with cryptocurrencies can often be hard to find. And then at the same time, we've actually got we've got open source code out there. So there are open source ideas. So everybody is just leveraging on top of each other's ideas, which means the rate of change is phenomenal. And if I'm old enough and ugly enough to have been through the whole .com era, and during that time, it was very much the technology was mine. I'm going to keep a hold of it, because that determined my next round of funding. Whereas within the whole crypto space, the open source nature has meant that everything's just ramping up incredibly quickly. And so, when also the regulators looked at decentralization, there's no traditional governance there. It presents some challenges, and it was just growing too quickly. And ultimately, it was considered to be out of control, ultimately. And so what we'd actually find is that the regulators just turned around and said, say no, then negotiate. And that's exactly what happened. As I'm sure you guys all remember, on September the 4th, I remember this too painfully, China banned ICOs overnight. Then in December, the SEC out of the States issued their first directive looking at the statement on cryptocurrency coins and ICOs. And the key points coming out of there: greater opportunities for fraud and manipulation. Investors should understand to date no initial coin offerings have been registered with the SEC. So this whole tenor of regulation and compliance has come right through to the center. And this in February of this year, where Jay Clayton said, I believe every ICO I've seen is a security. Now that obviously sends shivers down the spines of the market, and we know what happened. Okay? So, it's actually the crash we needed. Now, none of us like to lose money, and I totally accept that that might be a statement up there that might perhaps antagonize. But in reality, it's time to take a breather. And through that process, there's lots of things that have actually begun to happen. And it's one of those things that we need to have that sort of element of quiet reflection, okay? And obviously we're sort of hodling, chilling, and reflecting is probably the best way to describe where we're going. And I think when we actually reflect on what's actually happened within the ICO, the ICO, I'm going to call it the bubble, the tulip bubble, there's lots of stuff that's actually been very, very good. But one of the things about reflecting is that you actually do see shimmers of light as to where the future might be. And tonight, I'm going to show that that shimmer of light is actually the door to something much, much bigger. And we're going to step through that door right now. So essentially, there have been some very powerful learnings from ICOs. And I think this is really important to understand actually how good ICOs were when you consider the alternatives. And the global power of cryptocurrencies, we've all bought into ICOs, or most of us have bought into ICOs if you actually own tokens, even though you don't use them for the purpose for which they were intended. We know the power of cryptocurrencies. The usual thing, international funds clearing in minutes rather than it taking from 2 to 3 days from the banks. We know that there are very low transaction fees. I mean, I've got money in the UK. Every time I transfer money from here, from the UK to here, it's on average between $25 and $50, depending on the exchange rate. Got very bad exchange rates from the banks. They typically offer 2.5% to 4% below market rate, typically. So, and also one of the areas is there are very limited reconciliations through the whole smart contract code. Tokens are released and there are no foreign currency reconciliations. I mean, as part of an ICO last September, we got money in for 55 different countries. Money cleared in 3 minutes. It was crazy. It was fantastic, right? And the other major thing is there was global access to funds. In theory, any country with internet access could support an ICO. Now, obviously, there are regulation issues associated with AML, know your customer, anti-money laundering, and obviously sanctions. So the second thing that we need to pick up from the ICO space, and this is all very, very important, as you'll see, is the power of programmable money in financial instruments. So, where cryptocurrencies can automatically execute within the currency itself. And so there was the automatic running of ICOs, with the smart contract that would actually instigate, the allocation of tokens, the thresholds by which you had to go through to hit your targets, etc., etc. But it was fully automated. And if you extend these programming structures to other financial instruments, you can actually start to look at programming equities and actual stocks and those types of things, where you can actually look at voting rights, automated dividends, ownership, a whole variety of different structures. The third point was the enhanced liquidity. Now, in financial terms, that means there's a lot more sort of cash available in broad brush terms. And so when an ICO launched onto the exchanges, there was an immediate market that actually happened directly after the ICO. In most cases, obviously, this year it's been a bit challenged. There's an easy movement between global exchanges. I mean, how many of you actually have traded in the past month, say? Okay, right, so you're probably transferring between different exchanges, perhaps, maybe Binance, maybe Bitfinex or whatever it might be. And if you consider the traditional equities markets, it's almost impossible to move equities around the globe easily, quickly, and effectively. And it's at least 2 days, typically, in most countries, before you get the change allocated for equity ownership. With cryptocurrency, it's within, half an hour maybe, if you move between exchanges. So this brings us on to these little fellas. How many of you have actually got CryptoKitties? One. How many had CryptoKitties? Or anybody want to confess? You're amongst friends, you can tell us. All right, so we've got one. Okay, thank you, Brad. Thank you for putting your hand at the right time. But the key thing is that we can define unique ownership. And I think one of the really important and powerful things about CryptoKitties was that it was, the Generation Zero kitty sold for $100,000 plus within 2 months of launching. Now, what that says to me is it's too much money for too many geeks who've got not enough to do with their money. But also what it says to me is that those that truly understood the technology believed in it, and it was the power of the unique ownership that was actually bought and sold. People trusted it, who are actually building this stuff. Now that's actually really, really powerful. Okay? So if we can actually look at ownership of CryptoKitties, why can't we look at ownership of this? Anybody know what that is? Anybody suitably cultured? I had to look it up, I have to say. So I'm not going to be a smart ass. Anybody know what that is? Know which artist it is? Oh, it's a Picasso, right. Okay. I mean, sorry, yeah, so it's actually les femmes d'Alger, the women from Algeria. Now, how about if we actually look at just owning a part of that? Becomes interesting because the technology has already been proven in terms of what we're doing. Or this, looking at real estate, and maybe a chunk of that. Okay, if we can define ownership, that becomes very, very powerful. Or this, a classic car, just a part of this. Because I think the key thing is that ICO technologies and the platforms actually created one thing that was incredibly powerful. And that was easy access to global democratic capital. All right? It was almost like the Uber of capital at that particular time. Almost anybody with reasonable expectation for a lot of the ICOs could fund from anywhere that had internet access. And that's powerful. So, I think ICOs are actually the killer app for the blockchain. I think the layer and the structures, that everything that we've seen there is actually the killer app for the blockchain. And I'll explain why. The cryptocurrency bubble, overall, a lot of us are in that space. We eat, breathe, do everything for crypto. A lot of us, okay? And myself included, I love this space. I have healthy debates with people about certain issues in it, but I have a healthy, I'm very, very positive towards it. But of course, the banks have been watching this space, and they've been learning. And this is really important to understand. And it's also that the banks and the corporates have been decoupling blockchain from cryptocurrencies at a corporate level, anyway. And that's beginning, we're seeing that more and more. The more corporates that I talk to, it's all about blockchain. It's not about cryptocurrencies, because cryptocurrencies need blockchain, but blockchain doesn't need cryptocurrencies. And the regulators have now had the time to consolidate and to understand. And this is becoming a very, very important issue as well. Because the easy access to global democratic capital, what if that were regulated? What would actually happen would be this: easy access to global institutional capital. Now, broadly speaking, I'm not a lawyer, so I bow to any lawyers that are here. Essentially, a security token is a token that derives its value from an underlying asset, usually a tradable asset. And the majority are regulated. It's like a share in a company, a limited partner interest in a VC fund, part ownership of an income-earning asset, a whole variety of things. I'm sure there'll be a better legal definition which will come out according to the regulators that you deal with. But the idea of tokenizing, how many people have been to a casino within the past month? Okay, 3 months. 6 months? Am I the only one that goes to the casino occasionally? I do live in Pyrmont, I have to say, so that's a bit of a... Right, but this is the idea, okay? The actual a gambling chip is like a tokenized version of coins, of cash. Because can you actually trade those outside the casino? Right. But it represents the cash. And so, the tokenization of assets, it stores and transfers values just like cryptocurrencies. Okay? And there's a little bit of technology just in case there's, and this is a very sort of light touch. What does this represent? Who is it? Or what is it? Right, good, we've got some Star Wars fans, good. I thought maybe you were all falling asleep for a second. Okay, but the idea of a cryptographic hash is very, very simple, okay? Or in its essence. And this is, sort of tokenizing an actual underlying asset. So the sculpture represents the original file, okay? And then the shadow represents the cryptographic hash of that digital file. Now that can actually, that one hash can represent one file or a group of files, but as soon as you change anything in that file, that cryptographic hash will change. And it's a one-way relationship. And that's important just to sort of get that top level out there, because you can tokenize almost anything. Okay, so it's important to understand that. So, could we tokenize Les Femmes d'Alger? Okay. Well, let me ask you a question. How many of you would like to buy that? Picasso. Okay. How much do you reckon it's worth?
60 million.
60 million?
1,000 Bitcoin.
10 million?
It'll be in the tens of millions.
It was actually sold for $179 million in 2015. Now, how many people globally could afford that money? Probably 25, 50 people globally, or maybe institutions.
Wait till my article next week. Heaps of people.
Okay, okay, all right. I bow to your wider knowledge. Sorry, I'm okay. I'm a mere humble mortal. I apologise. But the idea is, who would actually buy 0.01 of that for $17,900? Put your hand up. If you would, genuinely, have a piece of a Picasso that would be in the Louvre Museum right now. You could get it for, $17,900. Okay, one. Okay, all right. What about this? 0.001 for for $1,800. How many of you would actually buy a piece of a Picasso that you could say was yours for that amount of money? I would. Personally. Okay, we've got a few more hands up. How much would you actually buy this for? Do you want 50 cents or something? Do you? Huh?
Why do I want a pixel of a Picasso? Do you know how much of a Pobo bloke I own point?
No, but it's not. That's not the idea. If you actually want to actually say you own a bit of a Picasso, and it's going to be it won't be in your house at any time. It'll be in the Louvre or somewhere like that, right? You can get exposure to that, that modern art, that segment of modern art, for example.
Wouldn't you have to pay $60 to get in anyway? Still every time. You can't tell them, hey, I'm an owner at the door.
Why not? Why can't you? Why can't you have a token that's actually a program that says, right, I'm a token holder, I get in to see this, free of charge.
Yeah, that's a good one.
Right. Thank you. Now you're understanding where we're going, right? Okay. So let me ask you the question: what would happen to the number of parties able to buy this Picasso if we could fractionalize that ownership? What do you think?
Competition. It'll be worth billions then in the aggregate.
Right. Well. Okay, I mean, what's going to happen to the number of parties that's going to be able to buy? I mean, what's going to happen to the number of people who could buy or groups could buy? What's going to happen? Is it going to increase, decrease?
Increase.
Right, okay, makes sense. And its price? Up, down?
Up, down.
Down.
Competition.
Controversial idea. I don't know. I mean, we'll come on to the sort of some peripheral ideas linked into this in a second. But imagine you could tokenize the ownership of real estate property. This is happening.
Timeshare.
Real cars. It's very similar to timeshare, but it's taking it to a new dimension, right?
Real estate investment trust.
You can even tokenize fractionalized ownership for VC funds, and the idea is instead of with a lot of early stage VC funds. They have to wait 3, 5, 7, 10 years to get their liquidity event. I mean, Terry, what's your average at the moment? 12 years. All right. Okay. So if you can tokenize the fund, you can tokenize various aspects of it, and you can get a liquidity event actually happening through a token. That becomes a very powerful sell. In July last year, Blockchain Capital did the first regulated ICO out of Singapore. They raised $10 million in 36 minutes. The key thing is that fractionalization removes illiquidity. So you get a better price discovery as more people and more companies can actually buy. Is it the Uber of global capital raising? Possibly. But institutions also have the ability to create new products. Because if you imagine that fractionalized ownership of the Picasso painting, somebody's got to sell that. Right? So institutions, what are they going to do? if they can create new products to sell fractionalized ownership, they're going to make money from it. So they can not only engage with the cryptocurrency space, they can participate. But there is a but, of course. At the moment, institutions cannot invest in unregulated and small markets like cryptocurrencies currently. I interviewed an institutional fund. He's been running for 20 years, and he's now going out on his own with a digital transformation fund. And absolutely, the institutions are looking, but they're saying, and I quote what he said, it's a pimple on a rhino's bum, the cryptocurrency markets.
Oh, sorry.
Okay.
What's that mean?
Right, well, use your logic. Anyway, but the cryptocurrency markets are 200 billion right now, today. Now, they've been up a bit higher, obviously, so I'm going to give credit where credit's due. Gold market's at 7 trillion. These are rough figures. The top 20 stock exchanges, $84.4 trillion as of April 2018. The global bond market's $113 trillion. The global real estate market, $217 trillion. And money that's actually in the world is about $95.7 trillion. You know what the unifying thing about all those markets I've just spoken about? They are the 5 asset classes institutions can invest in. Institutions are regulated by the mandates that are in there that allow them to actually invest. Insurance companies have to invest in highly regulated structures. As the total value of those markets, $517 trillion. Now, if one's looking at a risk portfolio, right, and you want to have access to a bit of a higher risk, but possibly high return, what happens if you actually contributed 1% to the digital asset space of that? Just 1%. Of all the people that are investing in those spaces. And they suddenly say, hang on a second, yeah, I like the idea of this Picasso token. I like the idea of the rare car token, or having access to some real estate property. If 1% went across, the market becomes $5.17 trillion. That's 25 times the crypto market. And after a while, when you've got people getting used to this, right, 5% would be $25 trillion. 125 times the crypto markets. But this is the key. Regulation is the key. All right? All the technology that's been through the ICO tulip bubble that we've spoken about has been proven. Albeit it's been experimental. It has been proven. There have been some scams, there have been issues that have been there, but it's all been proven. But the key thing is, don't expect the returns from security tokens to be like ICOs, in my view. This is why this is not investment advice. Because security tokens actually have performing assets that underpin the actual value of the token. So there'll be more traditional financial metrics that'll be involved. And do plenty of due diligence. If you do decide to get in them, do the due diligence, because there will be a number of crap projects that come through. And just here, security token of a dog with fleas will be a digital representation of a dog with fleas. There will be some crap that will come onto the market. So the key takeaways are, ICOs were our unregulated tulip bulb moment. ICOs showcase the core power of the technology. It is incredible what that technology has enabled to happen. It was an experimental phase, but fractionalized ownership with a regulated structure will see the market potential explode, in my view, and new financial products being created. Security tokens are actually more about regulation than they are about technology. A lot of the tech's already been proven. It's going to be how the regulators are going to react in certain ways, and there are people far better qualified than me to talk about regulation from different legal perspectives. The market is still in its absolute infancy, and it's still being defined, and that's where the opportunities really do lie. It's a massive opportunity, but don't expect those returns to come through for ICOs overall. But anyway, that's the podcast series that's launching next Thursday. We're soft launching tomorrow, and the book that I've written on the blockchain in plain English, Down the Rabbit Hole, as is the name of the podcast series. But I think the most important thing is this is right at the very beginning of this new tranche of money that's going to come into this space. and there's massive potential opportunities. Although, from a retail investment point of view, the returns, in my view, will not be the same as the ICOs. Oops. Thank you.